session is going to be centered on raising capital. And the session is going to be split up into two subsessions, one looking at the founder's perspective and the second looking at the funder's perspective. Giving us the founder's perspective, we have Dr. Brett Belchetz joining us again. Thank you very much, Brett.
Pleasure. Thank you for having me.
Great. So as we talk about raising capital from various sources, can you first start off by telling the listeners at what point in your business do you want to think about raising capital?
You should really think about it from the very beginning. So you've identified this pain point, you've identified this prospective solution, you understand how big the market is, and so now you've said, I want to go forward with this. So, excuse me, but what you're now trying to figure out is, what do I really need at this point to bring this to market, to bring it to life? So there are lots of entrepreneurs that are what we call sort of the pre-product stage. So they're still conceptualizing, they're thinking about it. You don't need investment at that point, but typically to go from I have an idea to I have an actual living, breathing product, that requires investment. Now the question is, whose investment is it? It doesn't necessarily have to be an investor that's not you. There are a lot of entrepreneurs where that investment's coming from themselves. Mm-hmm. And just because it's coming from your bank account doesn't mean that there isn't an investor or an investment. There is an investor, it just happens that investor is you. Mm-hmm. And you are getting issued shares in your company in exchange for your investment that you're making in your company. Mm-hmm. You as an investor, if it is you, should be just as diligent about, is this a good use of your money, as any other external investor should be. And so whenever you're thinking about getting external investors, one of the questions you should ask yourself is, why not me? Why isn't it my money? Mm-hmm. And I would say to any entrepreneur, if I was an investor, and again, I know you're having a conversation from the investor side, but if I was an investor, I would always ask the question, have you put money in yourself? Because any entrepreneur that's not willing to put their own money at stake in a new business idea probably doesn't believe in it all that strongly. And so if an entrepreneur doesn't believe in their business enough to put their own money on the table, I probably am not willing to put my money on the table. Now, the question then is, when do you need an external investor? And so typically when you need an external investor is when the scale of what's required is beyond what you yourself can fund. And that all depends on a number of things. It depends on what is your solution and also who are you? What are your circumstances? So your ability to fund your own innovation is going to be very different if you're a medical student who's deep in student debt and struggling just to get through school, versus you're a practicing physician that's been out of school for 10 years and you've actually amassed like a pretty decent amount of savings and you've paid off all your debt. In that second situation, you actually may be able to kickstart your business without bringing on any investment. In the first situation, you're probably going to need investors almost right away because you literally have nothing to give. You have an idea and you have your time, and maybe not even your time, but at least you have an idea and your energy to dedicate towards it. So all of these things come to bear. Now, my advice, and this is a little bit out of turn, but my advice always when you're thinking about starting a company is you want to bring in investment as far down the path as you can. And the reason is your business, typically, the closer you get to being a real product or even being in market and turning revenue, the further down the path you go, the more your business is worth. Yes. And so the earlier you bring in external investment, the more of your business you have to give them for that external business if you have to do it really, really early and your business isn't worth much. So one of the, I'll talk about pitfalls in another discussion, but one of the big pitfalls I've seen is entrepreneurs who raise too much money too early. And they end up at the end of the road not owning very much of their innovation at all. And eventually, even though the innovation ends up having a very good outcome, the business gets sold for a very large amount, they don't get very much of it because they had way too much money come in way too early. So you should be thinking about all these things. You should think about how much money is required. If it's a technological innovation, we have to buy and we have to pay for engineers, coders, etc. If it's a hard product, we have to think about manufacturing costs. At some point, you're going to have to think about things like sales and marketing and distribution. All of these things cost money. So start to add all of that up. I would also advise to anybody who is actually starting a business as a medical trainee, it's really important to have partners. This is one thing I'm going to say is don't try and do this on your own, because as you get into a business, it's big drain on your time, but there's lots of areas of expertise that you as a medical trainee are not going to have. And I didn't have when I was a medical graduate. So I brought in two partners, one of whom was a business person, one of whom was a technology person, so that when we started at our business, we could actually do a lot of the work without actually paying people to do this. So we could code our initial platform with the technology person without actually having to get investors for that. We could build out some of our initial marketing materials for investors and our business plans from the business person and figure out how we're going to structure our marketing and our sales efforts and all those things without having to pay external consultants for that. So all of that saved us a lot of money and allowed us to delay quite a bit what our first fundraising would be. So think about all of these things. I would urge people to have partners, and that's a really potent way to take longer, but have an idea of where do you want to get with your first investment? How much will it take to get there? So I would say for the most part, if you can't fund it out of your own pocket, what you really want to do is raise enough money from your first investment to get to a point where you can bring your product to market and have some early demonstration of success.
Yeah, definitely. I think that's very sound advice. And to your point about, partners, we talk about that in our session on team building. It's just so essential to amass, a series of partners and individuals that you work with that you can draw upon each other's strengths as well. And to your point, to some extent, that can also delay the need for capital, particularly early on when your valuation is actually may not be able to value the company.
Yes.
So, okay, that's great. Can you tell us a little bit more about, if you're kind of at a point where you've realized that you're at that inflection point and you want to scale and you do need to bring in external capital, what are the different sources of capital and how do you go about, securing them?
So in the early days, the source of capital for a nascent business is typically what we call angel or friends and family money. So angels because they're really kind and benevolent and usually will do no harm to you, and they're doing this more as a kind gesture versus making a lot of money. In our case, our initial round of financing, our friends, family, angels were all physicians in my personal network that I said, this is a great idea. I'd love to give you the privilege of being the first investors. They were all my friends. And so said, okay, no problem. I'll invest in it because we believe in you and because we're your friend and because we're also healthcare providers. So we kind of get the opportunity. So a lot of other entrepreneurs, it'll be, their parents, their uncles, their aunts, their cousins, could be somebody they know in the industry that they're trying to penetrate into. But that's usually your first round of financing. Beyond that, you'll typically go from that to people who are sort of more what we call formal angel investors. So you will find that there are high net worth individuals or at least higher net worth individuals that like to invest in nascent businesses. And this is a step before venture capital. And so our second round of financing actually came from a sort of more formal angel. So somebody I didn't know personally, wasn't a friend or family, but was referred to me, this is after we'd built the platform and we were ready to go, was referred to me as this is somebody who is really successful. They've made their own money and they're looking to invest and kind of give back and help other businesses get a start. And so not a venture capital firm, but a large, more formalized angel investor. Beyond that, the next step typically would be venture capital investors. So venture capital firms are firms that this is a business. So they raise they actually are fundraisers themselves. So they go out to other investors and raise a whole pile of money that then their job is to then find good companies to invest that money in. And so the typical venture capital model is they will invest in a lot of companies and place investments that are moderate in size across a number of companies, or moderate in size at least relative to the size of their overall investment fund that they're investing from. And the reason why it's called venture capital is because there's a venture. It's a venture. There is some danger to it. It's typically earlier stage companies. They're higher risk. And a venture capital firm typically understands that a relatively high percentage of the companies that they invest in will go bankrupt. So their model is and it's different for every firm has their own investing formula, but let's say for every 5 companies we invest in, 4 out of the 5 companies will go bankrupt. We'll lose all of our money. On that 1 out of every 5 companies, we're going to make 100 times our money. So net, our money, and this is just sort of made up math, but I'm just giving you the concept. Net, if we put in $5, we'll lose 4 of it. We'll have 1, but that 1 will turn into 100. So for every $5, we make 100. It's not quite like that, but that's the idea. So the fact that a venture capital firm invests in your business does not mean that you're going to be successful. And even the venture capital firm doesn't think it means that you're going to be successful. It means that you have qualified to the point where there's at least a 20% or so chance that you're going to be successful. And that's what they're counting on. Venture capital firms will take typically a fair amount of ownership in exchange. They write bigger checks and there's lots of different rounds. So there's what are called seed rounds and Series A rounds. And you hear all these different names of rounds. Those just speak to the state of maturity of the company. So seed rounds are usually for companies that are just brand new, either have no revenue or very early revenue. Series A is more for companies that have they've been around for a while now. They've got an established trajectory of revenue growth, and there is some proof that they can actually grow the business. And then from there it goes on to bigger rounds. Um, those are the main kinds of investors you're going to deal with, at least as an early stage entrepreneur. So it goes from friends, family to angels to larger angels to venture capital. Way down the path there, you'll hear the term there, what are called growth equity and private equity firms. They're a different model of investor. So they're very similar to venture capital firms in that they're a company that's in the business of investing. So they raise money from others to invest in entrepreneurial ventures. The big difference between private equity or growth equity and venture capital is growth equity and private equity are not in a venture business. They're not taking risk anymore. Mm-hmm. So when they invest in a business, this is a business that's been around for at least 5+ years, clearly is succeeding in the market, has a great trajectory of growth. They've figured out their market. They understand now that they're spending, say, $5 on marketing and we get $5 back, or $10 back. But if we doubled it to $10 on marketing, they would get $20 back. So we now know as a growth equity or private equity company that if we give them a lot more money, they can make a lot more money. It's a very scalable business. Mm-hmm. Their model is not we invest in 5 companies, we expect 4 to go bankrupt. Their model is we invest in 5 companies and we expect all 5 of them to grow successfully and be profitable for us. Failure is not typically an option or expected for a private equity firm or a growth equity firm. So much further along the journey, but you will hear about that, and it's important for you to understand what the difference is between that and venture capital.
Mm-hmm. No, that's very helpful. And I guess obviously, the type of funding that you seek depends on the stage of the business that you're in.
Yeah, for sure. It's all going to be about the stage, and also the industry you're in. So what you will see is there's cyclical trends. There's fashionable industry. So what you'll see even right now, AI is incredibly in fashion. Everybody wants to invest in AI. And so what you'll see is there are venture capital firms that are making investments in AI firms that have yet to earn $1 in revenue because they say this is the big thing. It's everybody needs to be a part of it. We have to. What they all talk about is our portfolios of investments have to be balanced. We have to have a little bit of a representation from every industry. And they all believe AI is going to have some very valuable future. And so you'll see funds that are saying we have no exposure to AI. We have to put some of our portfolio into AI. Let's just find businesses. And so a lot of them are making, it's the same thing that they did with cannabis a while back.
Yes.
Even what we do, telemedicine, was really in vogue in 2020, 2021. So you'll see these trends. And so if you happen to be in the right industry at the right time, you may actually get an investor that typically wouldn't invest in your stage company being willing to do it just to get into the industry. But you really can't count on that, and you can't make your business plan around that.
Yeah, some things are a little bit unexpected,
yes.
Unanticipated. Can you tell us a bit about how you find investors?
In terms of how I locate them, I'd say there's multiple ways to find them. A lot of it for us has been through recommendations and referrals. So as we started to get to be a bigger company, we started to get brought into the ecosystem of entrepreneurs. So I urge anybody who's starting a company, once you start to get going, sign up for the things that are available. The Mars ecosystem in Toronto is a great one. They have lots of connections that they can make for investors. They have investor days where they bring in investors. They try to socialize the companies they have with the investor community. There are other scale-ups and accelerators that you'll see around town. We, for a while, were located in a scale-up called 111, which I think is still around now. Again, same thing. Lots of investors are there and looking at the companies there. So get involved in the ecosystem. You'll meet a lot of people that will then introduce you onward to investors, or those ecosystems tend to raise the attention of investors. What you'll actually find as well is once you're part of that ecosystem and your company becomes known in any way, shape, or form, investors, they're constantly trying to find what the next investments are that they're going to make. So they're doing their own research. Mm-hmm. You tend to actually get a lot of inbound emails from investors saying, hey, we came across your company on the Mars website or the 111 website. We're interested in what you do. Can we have a meeting? And they'll find out about you. My impression from all of my experiences over time is that almost all of the investors that we've ended up taking investments from were actually warm introductions, more so than that.
Yes.
With one exception, I'll say one of our favorite investors, our Series A round was led by a German venture capital firm called Acton Capital. And the way that I found them is I got invited to, it's a very interesting story. I got invited to go to New York City. It was a Canadian accelerator or I can't remember who organized it, but some Canadian organization organized an event for Canadian companies to go to New York City to meet American investors. So I went, And the idea was you would go and pitch your company in front of a whole room full of investors who are your audience. And interestingly enough, none of the American investors at all were of interest to me, but I ended up meeting, or we weren't really of interest to them either, but we ended up meeting a German venture capital firm and had a great conversation with them. And then from there, it turned into them investing in us. And that was our Series A lead. So you never know where you'll find investors, but again, it's all about really keeping your ears open and your head to the ground, listening for opportunities, making sure that you expand your network. You will invariably in this world, because there's so much activity in entrepreneurial and startup ecosystems and so many investors hungry out there to find new business, you will get connected.
Yeah, no, absolutely. And as I always say, we're very fortunate to be here in Toronto to have these opportunities and connections and networks as well.
Yeah.
So say, you get to a point where someone's interested in investing in you and they want to do a little bit more of a deeper dive into your business. Tell us a bit about what a deal room is and how do you ensure that you have these documents ready in a
Yeah.
timely fashion so that you can actually meet all the milestones needed to execute on the investment.
Yeah. So a deal room is essentially it's an online folder. The best way to think about it's like a Google Drive folder, where you can put all of your documents. And usually you wouldn't use Google Drive for this, but you may if you don't want to pay for services. But there's lots of services where you can actually pay a fee to have a secure data site where you can upload all of your company information because investors want to know about your company. So the things that they're looking for, typically there's going to be what's called a management presentation. So a presentation of what's the problem you're solving for? How big? All the things we talked about in some of the previous sessions. How big is the opportunity? What's the market size? How does your solution solve that problem? What is your traction to date? What is the economics of going to market? How much money are you looking to raise? All of these things would be in your management presentation. Who are you as individuals? One of the things in early stage investing that investors care about a lot is who you are. They're investing often in people more so than the company itself.
Absolutely.
So your management presentation should outline all that. You should have, if you're operating as a business, any of your financials should be there. So, what's your profit and loss? How much money do you have in the bank and all that kind of stuff. That's really important for your business. Any IP that you have should be in there. Anything else that's pertinent to your company, like once you've started a business, your shareholder agreements will be there. There's something called a capitalization table that basically says who are all the shareholders in the business. They will want to know that. So basically all of the things that they would think about to actually potentially decide that they're going to invest in you will be in that deal room. In terms of running an investor process, my biggest advice to people is don't do it with one investor. The best way to get a good outcome is to have a relatively competitive process. So what you want to do is establish lots of ongoing conversations with different investors over time so that you've got about, half dozen at least investors that have some amount of interest in you. And then when you're ready to raise money, what you do is you organize your deal room, and you should probably do it through a formal software that can give individualized access to each of these firms. But then what you do is you go out to the investors and say, we're ready to raise money. We're gonna sign a non-disclosure agreement, which is just a contract that says they're not going to tell anybody everything what they see in that data room. Everything's confidential. We're going to sign a non-disclosure agreement with you. We're going to open up the data room, and we're giving all of the potential investors up until 45 days from now to make a bid. And that way, and you tell them that we're running a competitive process. There's multiple investors we're speaking to, because there's nothing that's a greater motivator than fear of missing out. So if an investor feels they're the only investor that you're talking to, they'll string you along, they'll take their time, and they're probably not interested at all. Versus when they hear that maybe there's 5 or 6 other firms that are speaking to you, it's competitive, there's a deadline, they all start to get a little bit more respectful in terms of how they behave with you. So
it's a lot. There's a huge bandwagon component to this, I feel.
Oh, yes. Yeah, very, very much. So you'll go through that process, and then typically what happens at the end of that thing is you get what's called a term sheet, which is essentially a letter of intent, which the investor says, these are the terms of the investment. We think this business is interesting. We think it's worth this. This is how much we'd like to invest. These are the basic terms. The term sheet usually includes something called, if you just say you're going to go with them, it's something called exclusivity, which what that means, once you sign, you're not allowed to continue talking to any other investors. So typically what happens after the term sheet is if you like it and you're going to move forward, you sign into exclusivity, and typically exclusivity can be 30 to 60 days, usually not longer than 60. And during those 60 days or 30 days, then you go into what's called deep due diligence, where that investor will rake you over the coals about your business, ask a million questions. They'll do detailed background checks on you and everything else you can imagine. And at the end of that, if you pass all of those tests, then they'll write you the investment. What I advise everybody to not be stingy on is through this process, if you're going to raise money, have a good corporate lawyer.
Absolutely.
The term sheet document and then the documents around the investment will be full of landmines you can step in. And if you don't have good legal counsel, you will get taken advantage of in multiple different ways. So it's really, really important that all of those documents are well reviewed by corporate counsel who will make sure that they're fair and treat you properly.
No, I think that's really great advice. I totally agree with that. One thing that I'm wondering, you talked a little bit about the timeline for exclusivity. What do you estimate in terms of just an overall timeline for fundraising? So, say you're a small company and you're raising a seed round, a
Yeah.
VC seed round. What do you think is kind of the time scale from when you first start conceptualizing the round to when you actually close and have that capital in your bank account?
Yeah. So I'd say it's at least 2 to 3 months for you to pull all of the materials together, like to pull together your business plan, your management presentation, your financials, all the other things that would have to go into that data room to get it ready. That's a few months. You probably want to have been cultivating relationships for much longer than that. Like if you haven't been cultivating relationships for at least 6 months before that, you probably will have nobody to invite to your process, so you'll be in trouble. Once you open that up and you say, hey, here's my deadline, I would typically say it should be at least a 45-day deadline from when you open up that data room to when you ask for term sheets to come. And then from term sheets, as I said, it's 30 to 60 days of exclusivity to close. So your overall process, I would say, is, probably almost a year from the time you first start thinking about fundraising to the time you're probably going to get the money.
That's substantial. Wow.
Yeah.
So the last point that I want to touch on is, the fact that ultimately, as you said, particularly with VCs, they're running a business. And so
Yeah.
their business model is, how can we get a substantial return on our investment? And in order to do that, they would need to liquidate the shares that they've invested in your company. And so can you tell us a little bit about what the exit strategies could look like for various companies? Just sort of very briefly, and to what extent you think this is something that should be conceptualized early on in the life cycle of the business.
Yeah, I'd say nobody has a crystal ball, so you don't really know what your exit strategy is going to be, and you should actually be thinking, do you even want an exit strategy? Because there are some people who start a business where their goal is not to sell the business, not to exit the business. They say, I love it so much, I want to run this forever. And that's okay, but that may also impact what investors think, because a lot of investors eventually want to get their money back, and if there's no strategy to ever get out of the business, then they might be hesitant. So it's all dependent, what your exit opportunities are all dependent on what is the economy doing, what are the markets saying about value, which sectors are in vogue, and a whole bunch of other stuff. How's your business doing? But there isn't that huge of a realm of places that a business can exit to. So either a business can sell, you sell to either what's called a strategic buyer or a financial buyer, and I'll tell you what each of those are in a moment, or you can go public. Those are really the three ways that you exit a business. So exiting to a strategic buyer. So a strategic buyer would be, this is like another company that likes our product, they like our services, and they, for instance, like in our, we had a strategic investor. And actually in our talk about types of investors, one thing I missed actually were strategic investors. So forgive me for that. That's really critical. So along the road, all those kinds of investors I mentioned are purely financial. So they're what are called strategic investors and buyers. So a good example for us at Maple was our last round, which we did 4 years ago. It's been a long time since we raised money. We had a large strategic investment from Shoppers Drug Mart. And so Shoppers Drug Mart, they're one of the largest healthcare brands in Canada. And they said, we want to be much stronger in digital health. We love Maple's technology. We would like to be a part owner of this company. So they came in and made a large investment into the company to own part of the company. So they're not doing it because they want to make a big profit. Their goal wasn't to say we want to sell our stake in 4 years and make a big profit. It's because we want to have some ownership in this space.
Good point.
So really different. And I'm sorry I missed that before. But similar to a strategic investor, you could have a strategic buyer. So a strategic buyer in our case could be Shoppers Drug Mart comes along, and I'm not saying it's going to be them, probably won't be, but they come along and say, we actually want to own the whole business. We'd like to buy everything. Or it could be a company that you've never actually taken an investment from, but who's in your space or in your industry. You could have a small company that's, working in AI, and a much bigger AI company says, we really like your AI technology. We'd like to integrate it into our greater thing. We're going to buy your whole company. So that's a strategic buyer. Financial buyer is a buyer that believes that they can buy your business and make more money on it. So they can make it bigger, they can make it stronger, they can make it more profitable, and then they can resell it for more. So a financial buyer could be a private equity firm. So I talked about those before. They'll buy your business. For them, their goal eventually will be in a few years, either they will buy it, sell it to a bigger private equity firm or a strategic buyer, or they'll take it public. Those are the things that they do. And then finally, I said going public is another exit strategy. So it all depends on the market. So in 2021, we had a craze in the stock markets where literally anybody with any business could have gone public. bad idea. Don't do that if you're following a craze, because almost all of those businesses floundered once they went into the public markets. Those kinds of things don't last. But typically, to take a business public, you have to have substantial scale. So usually these are businesses that are earning more than 100 million a year in revenue, usually even more than that. This is a very large enterprise type thing to do. Going public is not really an exit. It allows your shareholders then to be able to sell in the markets. But for you as a founder, if you go public, you're still operating the business. People expect you to stick around. So it's not like you can walk away at any time. So you need to know this is the world of possibilities. And what I'd say is you won't know which of these are the thing that you want to do in the end with your business. But when you're talking to investors, investors will want to understand, could this be a business that could appeal to a strategic buyer in a few years? Is it a business that would appeal to a financial buyer? Is it a business you could take public in a few years? So what you need to know is you need to be able to say to an investor, and this should be in your management presentation and in your talk track to any investor, here's how we think we could be appealing in 3 to 4 years or 5 years to a strategic buyer, to a financial buyer. Going public, different story. Maybe we think eventually we could go public, but you need to be able to tell that story. Here's the different ways our business could be an exitable business for you as an investor.
That's very helpful. Thank you so much.
Pleasure.
It's been a really great session. A lot of very important take-home points. So thank you for highlighting really everything that we were hoping to touch on. And we look forward to our next session on the funder's perspective for raising capital. And hopefully you'll be joining us for one more session on common pitfalls. So stay tuned for that. Thank you very much again, Brett.
Thank you.
Thank you.